From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to another episode of the Simple Numbers Profitability Playbook Podcast. That's Brandon Gray. I'm Mike Maxon.
Hey.
Here we are again, man. How's it going?
Better than last week. So, college football has a little bit of hope in each stool, so we're going to see how we go with that. So,
hey, yeah, what you been saying? You just need to play, who did they play again? Oh my gosh, I can't row. Yeah, you just have to play them. You get back on track. 72.
I'm still a skeptic. We'll see.
Hey, we had a community call today. Give a brief update real quick on what was presented to our clients.
Yeah, so one of the guests from a previous episode on our podcast, the Profitability Playbook, joined us, David Kohenig, and he was going through similar things to what we talked about in terms of, the market has shifted around marketing, especially the need to not just be a hidden expert, but to be an industry icon in your field. We went through some things that you can do to make that happen from a content perspective and what have you there. Everything from what you're posting on LinkedIn to how you're using AI to generate that content. Had some good discussion around that, and it really gets back to the strategy. Once you get the strategy in place, then you can find the help to implement it. But a lot of folks they're experts, but they're hidden. No one knows about it. And so, it was a great call with our Simple Numbers.
I'm gonna share one takeaway. I thought a line he said in it was, right, based on the current market right now, that people care more about expert over operator. Mm-hmm. So the look and feel and comfortability of that brand, that thought leader type mentality, actually means more to people a lot of times than how well you have the product or how great you deliver the service. And which it's crazy. It's a different world out there. But if you all get a chance, go out and check out that podcast, because he really nails it. That if you are an entrepreneur and you have the ability to build that personal brand and become what you call a thought leader, so that's in his quadrant, that is high visibility, new content that you're able to put out and deliver to the market. That's a valuable thing. And so if you got that, don't be what he calls a hidden expert. Get yourself out there, because people really care. Could be a big deal for your marketing efforts.
Hey, one other thing.
Oh, yeah, go.
If you're listening to the podcast, we're about to send out some information to everyone on our Simple Numbers email mailing list. So if you're listening but haven't signed up to receive that information, you need to go to simplenumberscri.com. And it's real easy there. You can click on join our mailing list, because there's going to be some things coming out from that. So make sure you go to simplenumberscri.com and sign up for it.
Yeah, that's going to be pretty awesome. So check it out. Please sign up for that newsletter. Love to have you on there. All right. We are going to talk about buy-sell agreements and valuations. So this is a big one and uber important, often overlooked, where, hey, two partners or multiple partners, or if you want to call it, of a business, start something great, but you never go get that agreement done. That hey, what happens if, right? And Brandon offered it off with when I say that what happens if death, disability, retirement, bankruptcy, divorce, disagreement between the two, anything like that. What is that triggering event, and what is the result over here? That agreement carries you through it, and that agreement dictates it. And you do that when it's a happy place, like me and Brandon, right? Our buy-sell agreement is I get to fight him and beat him in all circumstances. But no, seriously,
he's living the dream.
Yeah. Let that agreement guide you and take you through it. So hey, we don't have to fight here. This is the triggering event. Here's what the paperwork says. Here's what it goes. Brandon, Take it away.
Yeah, three times in the past week this has come up. So 3 different clients, 3 different triggers, 3 different events that are requiring them to kind of go, hey guys, we need to do something here. And guess how many of them had a buy-sell agreement? 0 would be correct. So when there's nothing documented and there's nothing written down, it's the Wild West. One person is thinking this, another person's thinking some completely opposite. And guess who wins in those cases? The attorneys. They always win in those cases. And so it's going to be expensive in all 3 cases. One we're going to talk about in particular around valuation in just a second. But in all 3 of those, it is going to cost a substantial amount in professional fees. That if they had just paid $500 to $1,000 a couple of years ago to have their buy-sell put in place, they would have avoided all of this. So Mike hit on a few things. Keep in mind, you may think today I've got a great relationship with my business partner, with a company that maybe is the capital partner and you're the operator, could be siblings, could be parent-child, you name it. We see every case, we see instances to where you go, well, it's just a family business. It's me and my uncle. Well, I can't tell you the number of family businesses that we've worked with that you and your uncle aren't getting along anymore. And it's not going to work out. Or even, you almost hate to talk about it, between a parent and a child. Multiple cases to where either negligence on one party's behalf or just they're not getting along and don't like each other, and it triggers it. And now we're going down a pretty messy road. And so regardless of who you're in business with, you need to make sure that you have it in place. A lot of times too, we see it to where you start out as the 100% owner, and then you bring someone on your team on as and they're a minority owner, but they still have rights as a minority shareholder. Depending upon what state you live in, those can be pretty substantial. And so you got to have these things in place. So let's hit some highlights and some, we won't tell too many stories here. We got a lot of them, but let's hit some highlights of things that we want to see and just some thoughts and ideas around that, that people have put in place. And so let's do the low hanging fruit first. So we don't want to talk about it, but death, it happens. Unfortunately, the easiest thing there is that you have a key man life insurance policy that the company is the beneficiary on, who can then buy the shares or the ownership units from the estate of the team member who's passed away. Now, the key with that is as your company grows, you might need to update the amount of insurance coverage that you have.
Mm-hmm. Just going to say that.
So, pretty straightforward. The second one, disability, same thing. If somebody becomes permanently disabled, what happens to their ownership? They continue to be an owner even though they may not be able to work, which, by the way, everybody should have a long-term disability policy in place to replace that income. But depending upon the severity of the disability, they may not even be able to contribute to their role as a board member or a shareholder. So if that happens, what are we going to do? The divorce one. So this really is going to be contingent upon state law. In a lot of states, you can get what's referred to, I believe, and I'm not, full disclosure, I'm not an attorney here. I'm not giving legal advice.
No.
I believe it's called a spousal consent that basically says, hey, if you become divorced from this person, you're not going to become an owner in our company. They held 50% of the shares. You're not automatically going to hold 25% of the shares. Rather, you'll receive compensation for your ownership of, through those marital assets that person has. So you want to look at and have in place potentially. We don't want an upset spouse as an owner because that could create a lot of havoc. But the most common, what is the disagreement? We just don't get along anymore. Something happens. You want to go one direction. Somebody wants to go another. You name it. We've heard all of them. And so if it gets to the point to where we are just best to go our separate ways, then what happens? How do we value the company? Is that done? There's several ways it could be done. It could be a formula. One that we use many times that Greg wrote about in the first book is the simple numbers economic valuation. It's a formula. So it can be a formula. It can be, hey, you hire somebody to value it. I'm going to hire somebody to value it, and we're going to average those two together. That's an approach you sometimes can take. In some cases, that can get fairly expensive. It could be as simple as, hey, here's what the equity is. We're going to divide the equity in half and pay it out. I mean, there's a lot of different things you can do there, but the key is you need to have some type of agreement in place that says, if we can no longer get along, and this is most common in 50-50 ownership, it's going to be triggered. One of them that we really like with a 50-50 ownership, there's different terms for it, but the one that I hear most common is what's called the smoking gun. So let's say Mike and I have a company together. We're no longer getting along. I can't take Maxon anymore. He can't take me anymore. So we are going to go our separate ways. And, we don't really have an agreed upon way that we're going to value the company or what we're going to do in terms of stating a value. And so pretty much, we could put in there that would say, hey, whatever one person comes to the table with in terms of an offer, the other person has the right to then counter their offer with the same amount. Okay, so here's how it works. I come to Mike and I say, hey, Mike, we're not getting along. I'm going to buy you out for $5 million. Well, I lose control at that point in time. Mike now has the right to buy me out at $5 million. So it keeps somebody from lowballing, obviously, in those kind of situations. You're going to come to the table with a fair offer because it could always be turned back on you. So you got to come with something you're willing to accept as far as that goes. And I've seen that, and there's legal jargon that can go with all of that and what happened. But the key is that you address those 4 Ds: death, divorce, disability, and disagreement. And that you've got for each of those what's going to happen in that case. Mike, any thoughts on that?
No, I mean, it's pretty straightforward. I mean, what my thing is with everybody is please get it done. I've been involved in a couple of these where it's not, and it just gets messy.
Yeah.
Real quick.
It does not end well. It takes forever.
Now, when I get a lot, one person always is going to think that sucker is worth a lot. I mean,
well, the way to assess fairness in these instances is one party thinks they paid too much and the other party believes they didn't get enough. And that usually means it was probably fair. But you need to have it in place as soon as you have more than one owner. That needs to be documented. Everybody signs it. Anytime you add an owner, you put that in place. And so the second part with that is, not only just determining those events and triggers and what it's going to do, but then the payout.
Yep. That's where I was going to go. How are we going to
do the payout? Because what we view our job as in this instance and in these circumstances is to protect the company. We want to make sure, because whoever's getting bought out is going to get some cash, and it's, in some form of payment. The remaining person, typically the only asset they have that's income generating to then facilitate that repurchase of stock or units, is the company. And so we try to make sure that we have a situation to where the company can stay healthy and survive through all of it. So you don't want to kill the golden goose. And, I've seen cases to where this was done and a value was arrived at through whatever methodology that was entirely too high for the cash flow of the company to service the debt. So years ago, we had a client, they had to get this, they had to run profit. And in their case, we compared it to revenue. They had to run profit as a percentage of revenue almost at 20% every year just to pay the note for the buyout of the previous owner. Yeah, that's a rock star performance. They have to perform at the highest level for the next 5 years just to service the debt. We're not even talking about, trade capital and infrastructure capital and buffer capital, all the other needs yet, just to service the debt. And so that was in place before we started working with them. And it was like every month, just a grind to hit the target so that you could service the debt. So that's the situation we want to avoid.
Well, Greg had a good one the other day. Believe it or not, I've been with Greg a lot of time. I haven't heard him say it much, but he said that if that payout is going to be more than 40% of the profits of the business, it's a no-go over the time period of paying out. So that dollar amount.
Yeah, because 40% is going to tax, 40% is going to that. And what remains, 40% is going to that. The rest, unless you just have a negative trade capital signature, which a lot of businesses don't have, it's not going to cash flow.
Yeah,
it won't work.
Yep.
And so, yeah,
that was just a good little nugget. Like, I'm like, oh man, that's just pretty easy to think about. If the money you have to pay is more than 40% of the profits of the business over the time frame you agree to on the buyout, no go.
Yeah. And so as you're structuring that, what are your options? Well, one is you can go to the bank, or, it can be backed by SBA potentially, or a rich uncle, whatever your source of funds. And you can take out a loan and you can write them a check the day that, the transaction closing, and they were off in the sunset. That's one approach. Don't see that happen real often, but it can. The second is typically, and most of the time the buy sell's written this way, you will receive monthly payments stated in an interest rate, whether that's, the IRS fund rate or whatever it may be, an interest rate on that cash that you'll receive. So you'll receive principal and interest. And it's going to be financed somewhere between 5 and 7 years. So, in most cases, if you're using that economic valuation formula that I mentioned earlier that we wrote about in the first book, a business can buy half of its ownership with the after-tax cash flows over the course of about 5 years. That's kind of the reverse engineering behind that formula. And so it gives you an idea kind of what you're looking at there. Where you run into an issue in an internal transaction, and this kind of gets us over a little bit into the valuations, Mike.
Yep.
Is whenever you
get into that, we just go in.
Let's just roll into it. Hey, I'm rambling. Let's just keep. So is whenever you use an external valuation, a market value. Okay. So when we talked about economic value, now we've moved over into, if the buy sell says for market value, that you hire and we're going to talk about this in just a second, you hire a third party to do a valuation. Because they're going to look at what are multiples that your type of business is selling for in the marketplace. And the issue you run into there is that market value is going to be higher because people in the marketplace can pay a premium for a business, because most of the time they can consolidate it with their existing operations. They don't have to bring in all the overhead. They can leverage the overhead, and they can pay a little bit more and still cash flow it, make it really profitable. So you kind of can run into that situation where, wow, I can make this valuation. I can't cash flow it. I can't make it pay. So you got to be careful about that part of what type of valuation are you going to have. Is it going to be a formula, or are you using a third party?
What about the payout? What about the payout length?
It's usually 5 to 7 years is what we typically would recommend. And in those cases, you could pay it off early. You want to have the language in there that would allow you, because your business may take off or what have you, or you may have a great year and you want to pay back that debt a little bit early. So you want to have some clauses in there to allow for that. You can get pretty creative here. I've seen some cases to where, the person who is selling their interest is concerned that, hey, I contributed a lot. I did a lot of work, and we weren't super profitable because we reinvested back in our business over the last 3 or 4 years. And now it's set to take off. And so they're nervous that, we've had low profitability, which the valuation's based on. And then the next 3 or 4 years, once I'm gone, because of the work that I put in, it's going to take off. And so I've seen some cases to where, there's an amount based upon the formula. Then if net income moves either dollars or percent of revenue around in future years, there's a kicker, that is added back from that standpoint. Or if they go to market, so, I bought Mike's shares out in September of this year. And then in December, I went to market and sold it for much more than what Mike got. Well, sometimes there's a kicker that if you sell within the next so many years, a percentage of that kicks back to you. So, there's a lot of different things you can do there around that. We like the approach of having an outline that you give to your attorney and have the attorney draw it up from the outline. Because if not, they've got a boilerplate document. They're probably going to use it, may or may not be a fit. And secondly, you may spend a tremendous amount of time and money on them developing that outline. So if you've got an idea, go ahead, put it on paper, and let them put the legally
Here's one to think about, and I think this is going to be a good one because I've had it come up. What about projections? Let's say after I beat you up, we're going to break up here and I'm going to buy you out. But you're like, whoa, Mike, I know we're at 20% right now, but man, we're turning out to be 30% by the end of the year. There ain't no way I'm buying it with what you're offering to me because it's going to be this.
Yeah. So we always make money on paper. I don't know how many thinking models you've done, Mike, to where we didn't. We don't always make it in reality. And so to be fair to our parties, you can, as I was mentioning earlier, you can have an amount based on history, and then should an amount of profitability be much higher than that over a certain time period, there can be a kicker that comes back. That's one way of kind of dealing with it. Once again, you'd want a third party involved to kind of look through the financials and say, because that other person might not be happy with you, and they go, okay, we're gonna bonus a bunch of money out to get that income down, those kind of things. So there can be some things put in there to kind of help with that. But a lot of times that's what we see as kind of a way to make sure that person's not being taken advantage of a little bit further down the road. All right. So I mentioned one earlier. Go ahead.
No, I have my feeling about the whole projection thing on that. And I thought about it. I don't like that. One, because, hey, like you're leaving, you're not going to participate in, and maybe there's a clause in there you put in based on when you leave. Because if you leave in February, right? Like, let's say the bot happens in February. It's like, man, from March to December, you ain't part of this company anymore. I mean, I don't know. That's one, but I have dealt with a few of them where that projection was a big thing. Like, hey, we're on pace. We've consistently been 20% growth year over year. Why am I going to settle for the amount today?
Yeah. And that's where you just got to kind of come to an agreement with, okay, is there going to be this kickback? Because, you could have had that in place in 2020 and then COVID hit. There's just too many things unknown between making it on paper and actually pulling it off. As far as that goes. So on the value side, I hit this a little bit ago when I was talking about the third party valuation. So you kind of can look at the different ways. One could be a formula, like we said earlier. One could be a third party valuation, as far as that part goes. So on the third party valuation, can be a great thing. You just need to do a little bit of homework and know what you're getting here. Ran into a case recently. A person was having a third party valuation performed. They believe they did some Google searches, went online, found a firm. Was not a good product. I am not a value analyst. I don't have the credentials and all that.
Yeah.
But I can tell you, when something doesn't smell right, you got to look into it. And this was a company that had nowhere near the profitability that would be needed to support the valuation. And turns out there were some errors made in it that weren't caught by the people providing it. And the thing that surprised me was the response they got of, hey, happy to look into this, but you need to sign a new retainer. So as with any industry, there's some great folks out there. Don't get me wrong, but there's also some folks who kind of want, so do your homework on it. Look in. We're happy to help at Simple Numbers. We've got some connections through our relationship with CRI, folks that are great to work with. You can do a good job. But yeah, just do your homework on that. Make sure you know what you're getting. And there's different levels. My understanding is there's different levels of valuation depending upon what you're getting it for. So one can be really expensive. One may not be as expensive. Once again, kind of depending upon the use. So, pay the little extra money now, get that buy sell in place, address all the D's, death, divorce, disability, and disagreement. Think ahead, think into the future to where, okay, if we add people, this can be adopted for them. If we have, folks coming in and out, what it may look like, which by the way, just one other little thing here. Never, ever offer equity to someone that you've never worked with it before. And I've got 1,000 stories on that one. And it's usually a company that's growing.
Why is everybody got to really equity, man?
That's the most valuable thing you have. Well, it's present project today. And so it turns out, it is the most expensive form of financing out there. So instead of paying somebody market wage, you're going to pay them a little bit less and they're going to get equity. Well, I can't tell you the number of times to where it either cost them a fortune in the end, and sometimes they're fine with that. It is what it is. But more times than not, I've got horror stories to where you bring someone in, you offer them the equity, they take the equity. Company performance does certain things. A year or 2 years later, you're not getting along. You go your separate ways. There was no buy-sell agreement in place, and it turns into a nightmare. I had one that actually pretty much put the company out of business several years ago. They had some great years. Person left, market shifted on them. They no longer could service the debt. And just a bad situation. So don't go down that path. No.
Awesome. Got anything else?
I think that, in words of Forrest Gump, that's all I had to say about that.
Yeah. Yeah, no, that was a good one. That's a big one. Love talking about it. Hate dealing with it. Especially if there's nothing involved.
Yeah. Yeah, it's, like I said, we always kind of take the approach of what's going to be best for the company, what's fair and equitable, what, just from a reality and based upon what the numbers are saying can be done.
Yep.
And, stay neutral in it. So,
yeah. Awesome. Well, thank you all for joining us. And we'll be back next week. I believe we do have more guests coming up here soon, too. So we're going to get more on and continue to roll. Like we always mentioned, if you have any topics you'd like us to discuss, please send them our way. We'd be happy to throw it on. You all take care, and we'll see you next week.
See y'all.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.